I recently learned about 20%, 1 in 5 RVs may get repossessed or surrendered, mostly involving financial difficulties faced by owners. If you're feeling upside down, owing more than your RV is worth, you're obviously not alone. In today's video, we'll give you 4 tips and techniques on what it means to be upside down on your RV loan, why it happens, and most importantly, how you can navigate this tricky situation. The thing about having a YouTube channel is you keep learning stuff. Some you want to talk about and some not so much. And that's how I've been treating this topic. But having a money coaching background finally made me want to share about this simple but not easy topic. First, let's talk about how RV loans work. You can get a secured loan, most likely through the RV dealer. Lenders qualify you for an RV loan based on your credit, income, total debt, and the specifications of the RV you're financing. Your RV becomes collateral for this type of loan, and the lender can repossess your RV if you default. If you don't qualify for a secured loan, you can also use an unsecured personal loan to buy an RV. Since your RV isn't collateral for the loan, you qualify based on your credit, income, and debt to income ratio. Rates and fees are usually higher than secured RV loans, and the terms are usually capped at 7 years, but there is no risk of losing your RV to repossession. Other considerations are the duration of the loan, interest rates, and down payments. Here's the key. All you need to know. You want the shortest duration, the lowest interest, and the largest down payment you can manage. But the most discouraging thing is depreciation. RVs depreciate faster than most vehicles, and if you buy new, you'll take the biggest hit. Let's use an example of a $50,000 purchase price. RVs typically depreciate about 20 to 30% the first year, then about 10 to 15% the following 4 years. That 50,000 RV would have a value of about $19,500 after only 5 years. Depreciation slows to 5 to 10% after 5 years, and there will always be some residual value even after many years. Second, let's talk about how a loan can become upside down. The most common reason for being upside down is rapid depreciation. There's a lack of awareness. Many potential RV buyers are not familiar with the specific depreciation trends of RVs compared to other vehicles, and the dealer or seller is unlikely to bring it up. For DA and I, it was an emotional attachment to the lifestyle and adventure we were seeking in retirement. We met in Tucson in 2006. We were almost 60. So between then and when we actually moved into our rig in 2013, we were planning our escape to the lifestyle we had been dreaming about. Fortunately, we bought both our rigs used, so we didn't take as big a hit as we might have, but we surely took a hit on this. And if depreciation weren't enough, large unanticipated expenses for maintenance or medical could keep you from meeting your obligations. So let me give you 2 quick ways to determine the approximate value of your RV. Remember, options mean nothing to dealers and only slightly more to buyers. jdpowers.com, then pricing and values, then RVs, or go to rvtrader.com. Just look at the type of vehicle you're considering, the year and the model, and then compare the approximate value to your loan balance to determine if you have positive or negative equity. Number 3 is the consequences of being upside down. Here we're looking at the financial stress, such as payment difficulties and credit score impacts. If you have a secured loan, your options for selling or trading the RV are limited. You can't sell an RV with a lien on it. If you're fortunate enough to find a buyer, they have to qualify for a loan, and then you're still responsible for the difference between what they borrow and your loan balance. Your lender may come after you for the balance or issue a 1099 tax form for that, whatever the amount is, which you have to declare as income on your taxes. Number 4 is solutions and strategies. I have a couple of good ones and a couple of terrible ones. A good one would be refinancing to lower the monthly payments or change the loan structure to make it more manageable. Another good one is to pay extra on your loan. Making extra principal-only payments will lower the balance. You can use an amortization schedule to see how much time and interest you could save doing this. We always use the financial calculators at bankrate.com, definitely the trusted name in personal finance. You could sell your RV and cover the difference, as mentioned previously. You may be able to trade in the RV and roll the negative equity into your new loan. This is a poor choice, and I wouldn't recommend it to anybody because it would put you upside down again right from the beginning. The worst choice would be to surrender it or let it be repossessed. If that's something you're thinking about first, please call your bank, explain your situation, and see what they suggest. They don't want a repossession. If you decide to proceed with repossession, your credit score will likely drop by 100 points or more. It'll remain on your credit report for up to 7 years and can make it harder to get improved for financing in the future. Other creditors may use it as a reason to increase interest rates on other obligations, and you will probably still need to pay the, quote, deficiency balance, unquote, the difference between the amount owed on the loan and the amount the lender sells the RV for, although that might be something you would try to negotiate with the lender. Thanks for tuning in to hear about RV loans and what it means to be upside down on one. Remember, being informed is your best defense against financial pitfalls. Whether you're navigating depreciation, considering refinancing, or exploring your options for selling, the key is to stay proactive and seek solutions that work for you. If you've had any experiences or tips to share, we'd love to hear from you in the comments below. Until next time, safe travels and happy RVing.